Good morning, listeners. It's the last day of the trading week, and as the ritual suggests, we say TGIF. This is Almus Market Mornings, your daily dose of global financial update with me, Shikhar Garg, and let's dive right into today's updates. Japan's inflation hits a four-decade high at 3.6% versus the expected 3.5%. Now, we have shrinking economy, high trade deficit, high inflation, everything working again on the Japanese macro front. The UK budget was released yesterday by Hunt, on which JK I'd like your views. But on the domestic front as well, RBI was seen lapping up this opportunity to rebuild its reserves a little. There was also some rumbling on the de-recognition of few clearing houses of India by the ESMA. So, JK, with all such updates, how should one be moving around in the financial markets?
Good morning. Yeah, Jeremy Hunt and James Bullard were grabbing all the attention of markets yesterday after a rather subdued Asian session. First, it was the UK finance minister who had the unenviable task of defusing time bomb set off under Britain's finances by Liz Truss mini budget and at the same time restoring stability and getting inflation down amid a growing cost of living crisis in the UK. The medium-term fiscal plan included broadly plans for 30 billion of spending cuts and 25 billion of tax rises. He has tried to help households in the form of further support to energy bills, extra fund for schools, hospitals, and social care, and possibly higher wage rises for public sector workers. At the same time, he has come up with eye-watering decisions on spending cuts and higher taxes for all. They were hinted earlier and they were needed if the chancellor was to hit his target of getting debt to shrink as a proportion of the GDP over the next 5 years. Markets seem to have been assured that the government will deal with the big deficits in these plans, and they managed to tell if the chancellor is to hit his target of getting debt to shrink as a proportion of economic output in the 5 years. Opposition Labour's acceptance actually helps with the credibility. But a lot of outcome, particularly the depth and length of recession in the economy, according to me, depends on how far some of the assumptions come true, like an end to Ukraine war or the post-pandemic supply bottlenecks, etc. For now, markets seem to have believed and hence stable. Sterling, which has recovered smartly from the initial downward reaction, is a testimony to this. And then James Bullard was on the wires in the US Times. The St. Louis Fed president, whose utterances have always been greeted with nervousness in the markets, spoke with much less adverse impact. He said that the policy change so far had little impact on the observed inflation. 5 to 5.25 on the terminal rate was likely the minimum. Perhaps the market seemed to believe that the peak inflation is in, and therefore the message was taken a bit easily. In fact, the recession gauge of 2 over 10-year further steepened to 69 basis points, which has never been seen earlier, was more on the radar. And concerning from growth perspective is the fact that the German yield curve has turned negative for the first time. That is, a 2 over 10-year spread in Germany is also at minus 0.11%, as 10-year yield has dropped by a whopping 11 bps yesterday. Add to this the consensus expectation of UK slipping into a recession for at least a year, it makes the overall bleak outlook complete. Perhaps reflecting these growth concerns, oil prices have slipped through key support, with Brent now trading nearly 10% down from the peak seen about 10 days ago. On the data from US, nothing much inspiring. Slump in housing starts and Philly Fed manufacturing index have kept the Dows encouraged, and the dollar was unable to make much headway with all these events, even ignoring a big jump in USD yuan by more than 2% after a big rise in the COVID cases there. What the market is likely to consider going ahead as we head into the last 6 weeks of trading in 2022 is this. Financial conditions have eased substantially. Real consumption expenditure is still near 5%. Stocks are rallying and have held on to the big gains broadly. 10-year yields are now below the Fed funds rate. So Powell has got a problem really. And if the upcoming PC does not show a fall, he's probably going to play the bad Santa role, when he appears on December 14th and spoil the party. But before we can make a good guess on that, we will have two important inflation number and a jobs data to consider. On the rupee front, of course, it's lot is due to a lot of the moves are due to the flows, and we have had enough of two-way flows so far. Post the big slump to 80-50, definitely we have moved 1% away from 80-50 and on the back of good buying. But since hitting 81, 30, 40 levels, we have seen inflows also, being dealt in the market. And we have settled somewhat into a higher range between 81 and 81.5, but the range was broken yesterday. But what appears from the markets so far in Asia, it is back below 81.55, which is considered as a key level for upside. I think we are closely tracking the dollar index as well, more to the yuan, which has weakened, but definitely upside should be limited to 81.80, 81.20, 81.80, 82 because of pent-up supplies, which still the investors haven't sold for several months, having seen USD-INR rise for almost 10 months in a row. So rupee, perhaps the bullish range would be 81.20 and 82, and the dovish range would be around 80.5 and 81.5. Thank you.
Okay, wonderful, JK. And yes, there's a lot of things happening. But interestingly, let's just hope that Jeremy Hunt is successful in diffusing the bomb, as you mentioned, JK, because as of now, what market was looking for was some assurance in their, task of dealing with the kind of debt, mounting debt UK had, and they've been somewhat there with the assurance. On the other hand, yes, the US Fed member was also seen speaking about the terminal rates, which is, as JK mentioned, being discounted around 5 to 5.25%. On the other hand, oil, as we speak, was one of the biggest factors for higher trade deficits across a lot of economies, have come down some bit on the backdrop of poor demand from Chinese economy, year-long expected recession from the UK, and also a bleaker economic picture. So there's a lot of things happening around the world and happening around the world financial markets as well. So folks, we hope you keep managing your risk. This is the end of the week and end of the updates for today. We shall come back again with another round of fresh updates in the next week. Thank you so much for listening.